All right. What is up, traders? What's up, tycoons? Super excited for today's video. The summary and key points of today's video is that defensive rotation is unclear at the moment. We're seeing some mixed signals out of two of our four indicators. We have transportations breaking down and the four pillars are in disagreement. We're going to break down what those are, why it's important. It's a very big warning sign, to the market right now. Number four is that we've got some binary events coming. Okay, we've got a lot of inflation data coming. Apple has its Apple event. And then number five, what we're going to take a look at is the stocks below their moving average. Okay. That's something also that's very important. I'm going to explain all of these things in a simple to understand manner so that way you guys can get a good idea of what the market is doing behind the scenes right now and to get a good idea of potential direction in the future. Be sure to smash the like button, subscribe to the channel if you guys are new. As always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Now, this is the S&P 500 right here. You can see, we're basically getting some controlled selling currently at the moment, right? And that's indicated by these, channels that we're trading in. So what you want to look for is this, is this really just controlled selling? And are we going to break out to the upside? If so, 447.9, let's just call it 448, is that key level we have to get above. If we can get a breakout retest from that area, then SPY can definitely head up to 450.2 sometime in the near term future. Okay. Another thing worth noting is that we have lots of support levels to the downside. We have a monthly pivot level here just below 447. We've got a weekly pivot level right here at 446.44. And then we've got some daily pivots down here as well to the downside. Now, keep in mind that we do have a gap down to fill on the S&P 500 on the SPY ETF. That's going to take us right around here to one of our pivot levels, right around 445.6. Okay, so if we do end up breaking through our support levels, right, you would look for a breakdown, retest, and push lower, and that would potentially be the gap fill play. Okay, and being that we have this controlled selling here, we do have to keep in mind that bulls can maintain the momentum. Even though this is a bearish channel, this is very controlled selling, a very algorithmic, taking profits. And it does look a little bit like a bull flag, right? You have the move up and then you have the controlled selling here and you look for a break, retest, push higher, really wanting to hold above and flip 448 into support from resistance. All right. So that's a quick, preview of what I'm looking at in the SPY ETF currently at the moment. Now let's talk about the defensives. Okay, so what we're looking at here is going to be the S&P 500 on top. We have our SPX ETF, and this chart right here, this is actually going to be high beta stocks to low volatility stocks. So this is a way to measure, is the market going defensive, is it going risk on, risk off? And what we're seeing is that this is still going down. Okay, this hasn't started to curl back up like the S&P 500 has. So for us to truly be going, offensive and more risk on, we need to start seeing the ratio of high beta stocks outperform low volatility stocks. And currently, it's not declining as much of a rapid pace as it was, but it is still going down slightly and, trying to potentially flatten out. So could CPI and some of these binary events be something that turns this to the upside, or could this send this down to the downside? So one right here, this is not looking clear, right? This is not looking strong for the bulls. We're not seeing a clear rotation into high beta stocks, which are, more risky generally versus low volatility stocks. Now here we have consumer staples to consumer discretionaries. One thing about the XLY ETF is that it's largely made of Tesla and Amazon, and both of those stocks had an amazing day yesterday. Okay, and both of those stocks have been performing really well. And so we're seeing consumer discretionary stocks outperformed consumer staples. This is a good sign for the market, right? This is a little bit more bullish. We're also seeing, bullish signs here on our credit spreads, right? We're actually seeing credit spreads loosen versus tighten. This is HYG versus IEI. So this is your high yield versus, kind of short term or shorter term, bonds at the moment. And we're seeing this increase. Okay. So this is also a good signal for the market. So these two are in confluence with, the S&P 500 going up, right? If you notice, these two have been in an uptrend the entire time that the S&P 500 has been in an uptrend, right? And so last but not least, we come here and we look at biotech, XBI, our biotech ETF. we really want to see this start to curl back up too as well, right? If you're looking for bullishness in the market, basically we're looking for high beta stocks to really start to outperform relative to low volatility stocks, and we're looking for the XBI, the biotech sector, to really start to get some juice behind it. Okay, once we get those two in confluence, with our discretionary to staples ratio and also our credit spread ratio chart here, then most likely we'll see the S&P 500 continue to go to the upside, right? But right now it's not clear. We only have 2 out of the 4 really showing continued strength. Now, I do want to give a quick shout out to the newsletter. Okay, I have a completely free newsletter giving you guys free trade ideas and also just dropping some gems and some really good knowledge on the market, whether it's bonds, whether it's stocks, whether it's commodities, different things like that. This was exactly 3 weeks ago, I believe. We talked about Tesla and the setup on Tesla, the abandoned baby chart pattern. And, if we go and take a look at where Tesla is now, here was that abandoned baby. Here was the trend line, got a very clean breakout retest, and we pushed up all the way higher. Very significant move. And that's how you can get gains like this, guys, 600%, 174%. Now, not every trade is going to be a massive winner. Okay. And you can't go into it, always expecting to have huge percentage gains. But, if you guys are fans of free trade ideas and free trade setups, I highly recommend subscribing to that newsletter. In the description or in the comment section down below is the link. And there's a website associated with it, so you can go back and check some of the previous, trade ideas and different setups. Now, we talked about transportations breaking down. So what we're looking at here, and this is a little bit of the Dow theory, is we have the Dow Jones Industrial Average right here. Okay, we have the Dow Jones Transportation Average right here, and we have the S&P 500 index right here. All right, so typically you want to see transportations, all right, and the Dow Jones, basically you want to see the Dow Jones performing, right? So you need to see industrials and you need to see transportations performing. And the reason being is because industrials are basically, if you see the stocks, right, reporting profits and revenues and going up, and you see the stocks in the S&P going up, you want to see the, industrial average going up, right? Because these are all of the people manufacturing those goods, processing them, making them, etc. And so to see confluence in the market, those companies should also be performing well, along with the S&P 500. And not only that, but now you have the Dow Jones Transportation Average. Okay. And, kind of the same thing, the companies that are transporting all of these goods across the country and across the world, they also should be performing well. And what we're seeing is the Dow Jones Transportation Average actually broke down below a key support level. These red lines here, they represent overhead supply, and the yellow lines basically represent support. And you can see the Dow Jones Industrial Average and the S&P 500 bounced off of support and near support. But meanwhile, the Dow Jones Transportations broke down. So this is a little bit of a warning sign, right? And it's very possible if we get a bad CPI and PPI and different inflation numbers, that this Dow Jones Transportation Average performance could be, a little bit of a sign of what's to come in some of the sectors of the stock market. Now, another thing that I like to look at is going to be the 4 pillars. So what we have is going to be XLK. That's going to be in our top left. Okay, so this is your tech sector. Then we have SMH right here. And then we have XLI right here, industrials, and then we have the home builders. Okay, now there's a reason why I look at all of these. And to break that down really quick, we talked about the industrials and kind of the Dow theory and, the Dow Jones Transportation Average. Well, you could argue now that the tech sector is the new industrial, basically the new industry, right? The new industrial sector that's really powering the globe, powering the economy, powering the US. And what transports all of that technology? Well, it's actually chips, right? It's semiconductors. Semiconductors are the ones that are powering. And really, if you were to say that, data is a commodity right now, and you were to commoditize data, well, what transports that data from A to B, right? From all these different places, that's going to be the semiconductors. So, all 4 of them on a weekly time frame, you can see are just kind of battling overhead supply. I've talked about it before. The market's not going to make new highs until we break out past overhead supply on our 4 pillars. Okay, we have the industrials down here and home builders. Home builders have really outperformed the S&P 500 for, the past few years. It's a really good sector just to look in. Warren Buffett has, a massive position in home builders that he's taken recently. Now, when we take a look at the industrial average, right, XLI industrial sector, look what it's doing also, right? It's very close to breaking down support. We'll see this a little bit clearer when we zoom in. And so we need to see, all four of these, performing either to the upside or performing to the downside, to really have a clear idea of where the market's going. And sometimes you can get clues whenever one is, not performing as well, right? So industrials are something you want to pay attention to right now, the XLI. You want to pay attention to the XLI and the DJT, the Dow Jones Transportation Average. Okay, if those two continue to break down, that could be a sign of what's to come for the other three pillars, which are going to be home builders, the semiconductors, and your technology sector ETF, right? When we zoom in on the daily, we can see here that XLK gap down, right? There's a gap here, and then 3 days later, it came up and filled that gap. Semiconductors have not filled their gap yet, right? They gapped down and they tried to push up higher, but couldn't get over Friday's highs. And so there is the chance that semiconductors and tech could extend this rally a little bit more, before CPI, and see semiconductors try to fill that gap to the upside. But again, when you look at the XLI right here, it's tested support about 3 or 4 times, 5 times, 6 times, 7 times there. So it's on the close, very close to breaking down. Now, of course, the flip side to all of that is going to be basically that industrials find support and start to rally, right? If industrials can find support and start to rally, that could be a little bit of, a tailwind for the market and help the market start to rally along with some of these other sectors here in the market, especially on the 4 pillars. And the last one we're going to look at, we talked about before, we need the percentage of stocks above their 200-day moving average to get above 50%, right? And so this line right here, 0.5, is your 50% line. It's got to get above there for the market to go bullish. One thing worth noting too is we kind of have this divergence, right, where we're making higher lows on the S&P, but the percentage of stocks, above their 200-day moving average is making lower lows here currently, more in a downtrend, right? And then when we take a look at the percentage of stocks above their 50-day moving average, right now it's at a pretty low level. Okay, it's only at about 36%. So, for things to really go bullish, we need to see both of these start to pick up. Okay, and until those pick up, that's potentially when we would break out past our new highs on the S&P 500. And until then, a lot of these different indicators are going to be, good warning signs for potentially when the market's going to be dropping, or for potentially, when it's a good time to wait for a better time to enter. So that's it for today's video. Smash the like button, subscribe. Don't forget to sign up for the newsletter, Investment Intelligence, using the link in the description or the comment section down below.